All right, welcome to the Explainer. Today, we're going to break down exactly how you can start earning passive income through dividend investing. And we've got a really clear goal in mind, getting you to your first $100 a month. So let's just cut right to the chase, shall we? To earn that $100 a month, which, is $1,200 a year, how much money do you actually need to have invested? Okay, check this out. What's so interesting here is how much that dividend yield changes the game. I mean, look, if you just invest in a broad S&P 500 index fund, you'd need over $92,000 to hit our goal. But if you target a quality high-yield fund like SCHD, that number plummets to around 31 grand. And if you get more aggressive, it can be as low as $12,000. So the big takeaway is that your strategy makes a huge difference in how fast you can get there. So we just showed you the destination. Think of this agenda as the map we're going to use to get there, step by step. We'll hit the math, the lingo you need to know, a couple of simple strategies, the magic of compounding, what traps to watch out for, and then, your very first steps. Okay, first things first. Before we invest a single dollar, we've got to learn to speak the language. Knowing these key terms is absolutely crucial for picking good companies that can actually pay you and keep paying you for years to come. So what even is a dividend? Well, it's not magic money, that's for sure. It's simple. When a solid, profitable company makes money, it can either pour it all back into the business, or it can share a piece of the pie with you, the shareholder. It's a real cash reward for being a part owner. Dividend yield, remember that from our first slide? All it is the annual dividend per share divided by the stock's current price. It's a fantastic little shortcut to quickly compare the income potential of different stocks. Honestly, the easiest way to think about it is like the interest rate you're earning on that investment. But here's the million-dollar question. How do you know if that dividend is actually safe? That is where the payout ratio comes in. It tells you what percentage of a company's profits it's using to pay that dividend. And if you see a number over 100%, whoa, that is a major red flag because it means they're paying out more than they're making. A dividend cut could be right around the corner. And finally, we've got the dividend growth rate because a great dividend doesn't just sit there, it grows. This right here, this is your shield against inflation. A company that's constantly giving its shareholders a raise is making sure your passive income buys you more, not less, every single year. Okay, so let's see how all these ideas come together into some actual strategies. And look, you really don't need a finance degree to get started. Honestly, for beginners, keeping it simple is often the best thing you can do. So when you're just starting, you've really got two fantastic options. On one hand, you can buy a dividend ETF, something like SCHD. This is basically the set it and forget it path. With one purchase, you own a tiny piece of hundreds of stocks, giving you instant diversification. It's perfect if you just want to keep things simple. Your other option is to pick individual Dividend Aristocrats. We're talking about companies like Coca-Cola that have increased their dividends for over 25 years straight. This is a quality-first approach for those who maybe enjoy a little research and want a portfolio of proven winners. Now, let's talk about the engine, the thing that's going to power your journey to $100 a month and way, way beyond. Let's talk about the incredible, almost magical power of compounding. The key to unlocking all this power is something called a dividend reinvestment plan, or DRIP for short. It's just a simple setting in your brokerage account. You just flick a switch, and it automatically uses the dividends you earn to buy more shares of that same stock. This creates a tiny little snowball that, over time, just keeps rolling and getting bigger and bigger and bigger. So, just how powerful is this? Well, the numbers are kind of mind-blowing. Over a 50-year investing life, just turning on that DRIP feature can lead to almost 400% more growth than if you just taken the dividends as cash. Think about that. And this chart just lays it out so clearly, even over a shorter period. After 25 years, the portfolio where dividends were reinvested is 78% larger. That is the compounding engine roaring to life. Your new shares start earning their own dividends, which then buy even more shares. You see how the cycle works? This is kind of a Wall Street secret. When you see those charts showing the amazing historical returns of the S&P 500, they're only that high because they assume every single dividend was reinvested along the way. Without that, the picture would look a whole lot different. All right, investing safely means knowing the risks. So before you run off chasing the highest dividend yields you can find, let's talk about the biggest, most dangerous trap that so many beginners fall right into. This is the #1 rule you have to burn into your brain. If you see a stock with a dividend yield of like 10, 15, 20%, your first thought shouldn't be, wow. It should be, wait a minute. If it looks way too good to be true, it almost certainly is. This is what's known as a yield trap. See, a yield can look crazy high, not because the company's doing great, but because its stock price has been absolutely tanking. Remember the math? Yield is the dividend divided by the price. If the price goes way down, the yield goes way up, making it look attractive when it's really a huge warning sign that the business is in trouble. So how do you protect your income stream? Easy. Diversification. If you're going to pick individual stocks, just follow 2 simple rules. First, own between 20 and 60 different companies. And second, never ever put more than 25% of your portfolio into any one industry, like tech or healthcare. This keeps you safe from one company or one whole sector going south. Okay, we've covered the math, the language, the strategies, and the warnings. Now for the fun part, the practical, step-by-step actions you can take to buy your very first share and get this whole thing started, like today. The actual process of buying a stock is way easier than you probably think, and it's pretty much the same everywhere. You just open your app, search for the company's ticker, like KO for Coca-Cola, decide how many shares you want, place your order, and that's it. You hit confirm and boom. Just like that, you're an owner. You're on your way to earning your very first dividend. You know, at the end of the day, the real secret to hitting that $100 a month goal isn't about perfectly timing the market. It's not about being a genius. It's just about starting as soon as you can, being consistent, and letting that compounding snowball do all the heavy lifting for you. The journey really does begin with that first share.